Something's changed in the way Australians are borrowing money, mate, and honestly, most people haven't even noticed it yet. If you've got a buy now, pay later account, you're carrying a credit card balance, or you've been thinking about taking out a personal loan this year, there's something happening behind the scenes that could affect the way lenders look at your application. At the same time, new personal loan lending across Australia has climbed to record levels according to the latest Australian Bureau of Statistics lending data. Now, on the surface, that sounds like a bit of a warning sign. But here's the thing, that's only half the story. Because once you dig into the numbers, the picture starts looking very different. A lot of the people driving this growth aren't necessarily in financial trouble. In many cases, they're people with solid credit histories who are making calculated financial decisions. Some are financing a vehicle, some are rolling expensive credit card debt into one manageable repayment, and others are simply taking advantage of a lending market that's become faster and a lot more competitive than it used to be. So which story is actually true, mate? Are Australians borrowing because they're doing it tough, or are they borrowing because personal loans have become a smarter financial tool than they were a few years ago? Well, the answer is actually both. And by the end of this video, you'll understand why personal loan applications have jumped in 2026, what Australians are really borrowing money for, how the buy now pay later rule changes fit into all of this, and the one mistake that could end up costing you thousands of dollars before you even sign a loan agreement. Quick disclaimer before we get into it, mate. I'm not a financial advisor, and nothing in this video is personal financial advice. This is simply general information to help you understand what's changing, so you can make more informed decisions and ask the right questions about your own situation. Now, let's start with the reason everyone already assumes. Yep, there's no denying that the cost of living has changed the way Australians manage their money. Housing costs, groceries, insurance, fuel, and just about everything else seem to cost more these days. Because of that, economists say more Australians are either taking out personal loans or using them to consolidate existing debt into a single repayment that's easier to manage. And to be fair, for plenty of households, that makes perfect sense. But here's where the story gets a lot more interesting, mate. If you look beyond the headlines, you'll find that people aren't just borrowing because they're under financial pressure. One of the biggest reasons Australians continue to take out personal loans is to finance a vehicle. Others are borrowing for home improvements, while many are using personal loans to pay off high-interest credit card debt and replace it with a structured repayment that's often easier to budget for. So instead of imagining someone borrowing because they're completely out of options, it's often someone replacing an aging car so they can keep getting to work, renovating their home, or simply trying to reduce the amount of interest they're paying each month. That's a very different picture from what the headlines sometimes suggest. Now here's another change that's been happening quietly in the background, and it's something a lot of people still don't know about. Since 2025, buy now pay later providers have been brought under Australia's consumer credit framework. In simple terms, mate, that means stronger consumer protections are now in place, and lenders may increasingly look at your buy now pay later commitments alongside your other debts when assessing a personal loan application. Now don't stress, that doesn't automatically mean having a buy now pay later account will hurt your chances of getting approved. Not at all. If you've been making your repayments on time and using those services responsibly, that can actually demonstrate positive credit behavior. The issue usually comes when someone has multiple buy now pay later accounts running at the same time without fully realizing how all those repayments add up. Lenders aren't just looking at one payment, they're looking at your overall financial commitments. And honestly, mate, that's the key takeaway here. It's not the fact that you use buy now pay later that's the problem. It's whether all of your debts combined still leave you in a comfortable position to repay any new loan you apply for. Now, this is where things become even more important, mate. These days, lenders aren't just asking, can this person afford the repayments? They're taking a much closer look at how you've managed your money over time. Your repayment history, your existing financial commitments, and your overall credit behavior all play a much bigger role than they used to. In other words, they're not only looking at where you are today, they're looking at the financial habits you've built over the past few years, and that can make a massive difference. Two people could apply for almost the exact same personal loan, earn similar incomes, and even borrow the same amount of money, yet still receive completely different loan offers. Why? Because one person has consistently paid their bills and debts on time, while the other has missed repayments or built up a weaker credit history. From a lender's point of view, that changes the level of risk, and risk usually affects the interest rate you're offered. Now, that might not sound like a big deal at first, but over the life of a loan, it can really add up. Even a slightly lower interest rate could save you thousands of dollars, while a higher rate could mean paying far more than you expected. That's why looking after your credit history isn't just about getting approved anymore. It's about making sure you're not paying extra for years down the track. There's another reason personal loans have become more common as well, and it's got a lot to do with how much the lending industry has changed. Not that long ago, applying for a loan often meant booking an appointment, filling out piles of paperwork, and waiting days or even weeks for a decision. These days, mate, the whole process is a lot quicker. Digital lenders and online application systems have made it much easier to compare different loan products, submit an application, and in many cases receive a decision much faster than people could just a few years ago. That increased competition has also given borrowers more choice. Instead of feeling locked into one lender, many Australians can now compare interest rates, fees, repayment options, and loan features across multiple providers before deciding what works best for them. And that's generally a good thing because more competition often encourages lenders to offer better products and more competitive pricing. But here's something worth remembering. Just because it's easier to borrow money doesn't necessarily mean it's always the right time to borrow. Fast approvals and simple online applications can sometimes make people focus on how quickly they can get the money instead of how much that loan will actually cost over the next 3, 5, or even 7 years. And that's probably one of the biggest traps people fall into. It's easy to get excited when you see a low weekly repayment advertised, but that repayment doesn't tell the whole story. What really matters is the total amount you'll repay over the entire life of the loan, including the interest and any fees along the way. Sometimes a loan that looks cheaper each week can actually end up costing significantly more overall. So when you put everything together, mate, it becomes pretty clear that Australia isn't experiencing just one borrowing story right now. It's actually several different stories happening at the same time. Some households are genuinely feeling the pressure of higher living costs and are borrowing because they need a bit more breathing room. Others are making deliberate financial decisions, whether that's buying a reliable car, renovating their home, or replacing expensive credit card debt with a loan that's easier to manage. That's why the record lending figures don't tell the full story on their own. The headline numbers might sound dramatic, but they don't explain why people are borrowing. And understanding the reason behind the borrowing is far more important than simply looking at the size of the numbers. So, if you're thinking about applying for a personal loan this year, mate, don't make the mistake of focusing only on whether you'll get approved. Approval is only one small part of the decision. The questions that really matter are the ones that'll affect your finances long after the money lands in your account. First, ask yourself this: how much is this loan actually going to cost over its entire life? Not just the weekly or monthly repayment, but the total amount you'll pay back once you factor in the interest and any fees. That number is often a lot more important than the repayment that's advertised. Next, think about whether consolidating your existing debt will genuinely save you money. For some people, rolling multiple high-interest debts into one personal loan can reduce the amount of interest they pay and make their finances much easier to manage. But that's not always the case, so it's worth doing the maths before signing anything. And finally, ask yourself whether you've taken all of your current financial commitments into account. That includes your credit cards, any buy now pay later accounts, car finance, and any other repayments you're already making. The more accurate the picture you have of your finances today, the better your decision is likely to be tomorrow. Because here's the reality, mate. Big financial decisions rarely feel like a mistake straight away. Most people don't realize whether they made the right choice next week or even next month. It's usually a year or two later when they look back and realize they either saved themselves thousands of dollars in interest, or ended up paying thousands more than they really needed to. And I think that's the biggest takeaway from all of this. Personal loans aren't automatically good, and they're not automatically bad either. They're simply a financial tool. Used for the right reasons and managed responsibly, they can help people finance major purchases, simplify repayments, or even reduce the cost of expensive debt. But if you rush into one without understanding the full cost or how it fits into your overall financial situation, it can become a very expensive lesson. So, mate, before you borrow, take a bit of extra time to compare your options, understand exactly what you're signing up for, and make sure the loan genuinely works for your situation, not just today, but over the next few years as well. If you found this video helpful, send it to someone who's thinking about getting a car loan or a personal loan this year. It might help them avoid an expensive mistake, and I'd really love to hear what you think. Do you reckon the rise in personal loans shows Australians are becoming smarter with the way they manage their money, or do you see it as a sign that household budgets are still under real pressure? Jump into the comments and let me know your thoughts. It'll be interesting to see where everyone stands on this one.